Hello, everybody. Welcome to Friday. Don't have the show today. Just wanted to do a quick summary of this week. Really wanted to encapsulize this week. This has got to be one of the best weeks of the year. Up almost 6% for the year. I'm sorry, for the week. Really fantastic week altogether. The anatomy of a recovery, as I see it, is that, you get this big stretch, the market starts to consolidate, maybe come down, came down about 10% in this case. You get to some support level. In this case, it was 4,200 to 4,050. It got to 4,137, I believe. And then, buying comes in and kind of gets it going. And then there's this kind of panic buying that happens from the short covering that, we got a lot of short interest out there right now. And you're seeing a market here that, makes almost 6% in a week. And that's why you kind of need to be in there. You have to stick with the primary trend. Yes, the market was down 10% from the end of July, but we hadn't broken the primary trend yet. The signals and the pieces that I look at that kind of determine where the primary trend is were still intact to stay in there. So we've had a full exposure to the stock market since February when we got our overall, move upward in that direction. And we're just rotating through the different pieces, that are kind of trying to catch those waves as things go. And we don't switch over to our more, conservative version of investing until we get, a primary trend that's on the downside. So you kind of invest with the trend. So for example, the bond market has been in a primary downtrend, and we use these signals, green, yellow, red, for that. We have two green signals now in the bond market, so we're fully in the bond market. But if we get a yellow, we move all of it quickly to something more conservative in the bond market. If we get a red, we move to T-bills, just because that's still in a primary downtrend. That could change. It could move into a primary uptrend, and we would start treating it like we're treating the stock market portion of our portfolio right now. Really the things that transpired this week, Monday, Tuesday, we were up before the Fed meeting. That's happened a few times, and then the Fed meeting happens. They say some negative things, and the market fell. That's what happened, last month. But this week on Wednesday, Chairman Powell, in my opinion, kind of hinted at the fact that they might be, waiting for quite a while here before they raise rates again. If you look at the futures market, the market is expecting that there is no more rate increases, at least at this point. Again, that can change. One of my fears, and I'll just kind of talk about this, but I think that things do have to slow down a bit because we had this 4.9% gross domestic product. We've got all these pieces that are, I think, quite hot. I'm a little worried that that's going to cause some resurgence of inflation, and then we're going to start all this over again with the Fed, going up and up and such, trying to bring that down. One of the things that happened today that really got the market going, the market was up 0.9% today, was the fact that the expected new jobs created last month was 180,000, and we came in at 150,000. And so again, usually we want more and more jobs, but in this particular environment, we have to be a little bit careful, that the market doesn't get, too out of control on the job market, because that can cause inflation also. So a little bit soft there. I think that's really a really good number. It wasn't, 50,000 jobs or something. It was close to 180, which is what was expected. So that really drove things today. I thought maybe today we'd be down. We have a really big stretch going on for the first 4 days of this week with this big move that's been happening. And then Apple last night, reported earnings. I thought they were decent earnings, but some of the commentary trying to defend what's happening in China and those type of things, and Apple was down after hours. I thought maybe that would bring the market down. But then this morning when the jobs report came out, we had a run right away, and it's, did really well this week. So we're not really stretched out. There's a few measures I look at for very short-term stretch. One of them called rate of change, which is a 5-day look at the percentage rate of return versus other 5-day looks, going back. We're pretty stretched on that. 5.8% gain in a week is a big one. However, if we look at, some of the other measures that I look at, we're not at a full stretch. I would not be surprised to see some resting next week at some point, maybe early in the week or what have you, just because we've had such a run. However, there's still a lot of short interest, and so you can continue to get these pieces that really move. So what we're looking for here in this kind of anatomy of a recovery, so first we get the bounce, then we kind of get the panic buying from the short covering that creates these big weeks. But what we really need to do is to establish a high that's higher than the last high. So we hit a high back in July, and then we had two other highs since then, both of which were lower. So we're kind of, if you connect the dots there, that's starting a primary downtrend. So you break that, at least in one fashion here, by getting to a new high that's a little bit higher than the last one. We're only about 20 points away on the S&P 500 from doing that. So that's something we'll be watching for next week and see if we can do that. Because I think if we can get it back into this, starting to set new higher highs, we could get to a new high for the year and maybe get above that July high. We're not that far from it. You do get these good rallies here at the end of the year. November is the second best month of the year on average. April's the first best month of the year on average. The best 6 months is, of course, November through April. So this is a time frame, we can see some motion and see some money coming in. There's a lot of money that's not in the stock market because it hasn't been behaving, very well, with a 10% drop, since July and those types of things. So, but oftentimes we kind of have to hang in there and wait until, the trend truly changes, and that hasn't happened yet. So this has worked out really well so far. So anyway, that's what's happening this week. Everybody made great money this week. We still got a ways to go to get back to where we were back in July. But nonetheless, it was pretty decent. We saw construction spending report that came out this week was the ninth month in a row that was higher. We've got earnings that I think are pretty good. The mood of the market has changed quite a bit. And one thing to be aware of, at the end of October, October 31st is the last day that mutual funds can book a loss that they can then use for 2023. And so oftentimes you'll see, like the last couple of weeks of October, a lot of sell-off. Combine that with the situation in Israel, and we had, pretty decent drop from the 7th of October to the 31st of October. And then the clock changes, and boy, it just took off here as we went into this new year's or new month. So really, great market so far. We'll see if this continues. I'm very excited about it, but the market doesn't care how excited anybody is about the market. You just kind of watch and pay attention and see where things go. But look forward to being able to see you again next week. I'll obviously be doing my normal daily videos, and then we'll have a show next week, and we'll do a summary then also. So thank you for joining me. Look forward to seeing you on Monday.